For years, the most powerful force shaping the global economy has been almost invisible. No dramatic headlines. No breaking news alerts. No crowds gathering outside stock exchanges. Just a small number, quietly adjusted in central bank meeting rooms around the world. Interest rates. When they fall, the change feels subtle. Borrowing becomes easier. Mortgages look more affordable. Businesses find it simpler to expand. Markets respond with optimism. Growth appears to accelerate. Confidence returns. It feels like progress. But beneath this calm surface, something more fragile begins to take shape. Because while low interest rates can stabilize an economy in the short term, over time they can also inflate asset prices, encourage excessive risk-taking, and quietly build the foundations of financial bubbles. By the time these bubbles become visible, they often feel sudden and unexpected. Yet their origins can usually be traced back to long periods of accommodative monetary policy. To understand how this happens, we need to start with a simple question: what does it actually mean when money becomes cheap? At its core, the concept is straightforward. Interest rates represent the cost of borrowing. When central banks lower rates, they reduce this cost, making it easier for households, businesses, and governments to access credit. The intention is clear: stimulate spending, support investment, and prevent economic downturns from deepening. In times of crisis, this strategy is not only effective but essential. After the 2008 global financial crisis, central banks around the world slashed interest rates to near zero. Similarly, during the COVID-19 pandemic, aggressive monetary easing helped stabilize financial markets and prevent a collapse in economic activity. In the short term, these policies work remarkably well. Lower borrowing costs encourage businesses to invest in new projects, households to purchase homes and durable goods, and governments to finance fiscal support. Financial markets respond positively, reflecting improved expectations about future growth. But the story doesn't end there. When interest rates remain low for extended periods, they begin to reshape the behavior of economic actors in profound ways. The first and perhaps most significant effect is on asset prices. To see why, consider how investors evaluate opportunities. Every investment decision involves comparing potential returns to the risk-free rate, often represented by government bond yields. When this baseline rate falls, even modest returns from riskier assets begin to look attractive. As a result, capital flows into stocks, real estate, private equity, and other investments offering higher yields. This phenomenon is often described as the search for yield. Investors, unable to achieve their desired returns through safe assets, are pushed toward riskier alternatives. Over time, this influx of capital drives up asset prices, sometimes far beyond their underlying economic fundamentals. The mathematics behind this process is both simple and powerful. The value of an asset is typically calculated as the present value of its expected future cash flows. When interest rates decline, the discount rate used in this calculation also falls, increasing the present value of those cash flows. In other words, even if the underlying earnings of a company or the rental income from a property remain unchanged, their valuations can rise significantly simply because the cost of money is lower. At first, this effect appears benign. Rising asset prices create a sense of prosperity. Homeowners see the value of their properties increase. Investors enjoy strong portfolio returns. Businesses benefit from higher market valuations, making it easier to raise capital. However, this apparent prosperity can mask the gradual formation of financial bubbles. A bubble occurs when asset prices rise substantially above their intrinsic value, driven not by fundamental improvements but by expectations of continued price appreciation. Low interest rates contribute to this dynamic by making borrowing cheaper and encouraging leverage. Leverage amplifies both gains and losses. When investors can borrow at low cost, they are more willing to increase their exposure to rising assets. This additional demand pushes prices even higher, reinforcing the belief that the upward trend will continue. A self-reinforcing cycle emerges. Rising prices attract more investment, which in turn drives prices further upward. The housing market provides a clear illustration of this mechanism. In the early 2000s, low interest rates in the United States and other advanced economies contributed to a surge in mortgage lending. As borrowing became more accessible, demand for housing increased, leading to rapid price appreciation. Homebuyers, confident that prices would continue to rise, took on larger mortgages, while financial institutions expanded lending through increasingly complex mortgage-backed securities. On the surface, the system appeared robust. Homeownership rates increased, construction activity expanded, and financial markets thrived. Yet beneath this stability lay a growing vulnerability. When interest rates began to rise and housing prices stalled, the intricate web of leverage unraveled, culminating in the global financial crisis of 2008. Real estate is not the only sector affected by prolonged periods of low interest rates. Equity markets also experience significant valuation expansion. Companies can borrow cheaply to finance share buybacks, mergers, and acquisitions, boosting earnings per share and supporting higher stock prices. At the same time, investors seeking returns allocate more capital to equities, further elevating valuations. In recent years, technology companies have been notable beneficiaries of this environment. With abundant and inexpensive capital, many firms have been able to prioritize growth over profitability, leading to soaring valuations even in the absence of consistent earnings. While innovation and technological progress are genuine drivers of value, the role of cheap money in amplifying these trends cannot be overlooked. Another important consequence of prolonged accommodative monetary policy is the accumulation of debt. Low interest rates make borrowing more attractive for governments, corporations, and households alike. Over time, this can lead to a significant increase in leverage across the entire economy. While debt can support productive investment, excessive leverage reduces financial resilience. As debt levels rise, the system becomes increasingly sensitive to changes in interest rates or economic conditions. Even modest increases in borrowing costs can strain balance sheets, triggering defaults and financial distress. This dynamic creates a delicate balancing act for central banks. On one hand, maintaining low interest rates supports economic growth and financial stability in the short term. On the other hand, prolonged accommodation can contribute to the buildup of systemic risks that may ultimately threaten stability. The global financial system's experience following the 2008 crisis illustrates this tension. In the years that followed, central banks implemented not only low interest rate policies but also unconventional measures such as quantitative easing. These actions injected vast amounts of liquidity into financial markets, further supporting asset prices. While these policies were instrumental in stabilizing the economy, they also contributed to rising valuations across multiple asset classes. Global debt levels increased significantly, and concerns about asset bubbles became more pronounced. By the time inflationary pressures emerged in the early 2020s, central banks faced the difficult task of tightening monetary policy without triggering financial instability. The transition from low to higher interest rates often exposes the vulnerabilities created during the period of accommodation. As borrowing costs rise, leveraged investors may be forced to deleverage, leading to declines in asset prices. This process can be rapid and self-reinforcing, as falling prices prompt additional selling and further tighten financial conditions. The concept of duration risk also plays a crucial role in this context. Assets with cash flows extending far into the future, such as long-term bonds or high-growth technology stocks, are particularly sensitive to changes in interest rates. When rates rise, the present value of these distant cash flows declines, leading to significant price adjustments. Beyond financial markets, the effects of low interest rates extend to broader societal outcomes. Rising asset prices tend to benefit individuals who already own financial assets, exacerbating wealth inequality. Meanwhile, those who rely primarily on wages may experience limited gains, even as the cost of living increases. Housing affordability, in particular, becomes a pressing issue as property prices outpace income growth. There is also a psychological dimension to the formation of financial bubbles. Extended periods of rising asset prices can foster a sense of complacency and overconfidence among investors. Behavioral biases, such as herd behavior and the fear of missing out, further amplify speculative dynamics. As more participants enter the market, the distinction between investment and speculation becomes increasingly blurred. Ironically, the very policies designed to stabilize the economy can contribute to these behavioral dynamics. By reducing volatility and supporting asset prices, central banks may inadvertently reinforce the perception that risks are limited. This perception can encourage even greater risk-taking, setting the stage for future instability. It is important to emphasize that low interest rates are not inherently problematic. They are a vital tool for managing economic cycles and responding to crises. The challenge lies in recognizing and mitigating the unintended consequences that can arise from their prolonged use. Policymakers have sought to address these risks through macroprudential measures, such as stricter capital requirements for banks and limits on mortgage lending. While these interventions can enhance financial resilience, they are not always sufficient to prevent the formation of asset bubbles, particularly in a globally interconnected financial system. The international dimension of monetary policy adds another layer of complexity. Differences in interest rates across countries can lead to significant capital flows, affecting exchange rates and financial stability. Emerging markets, in particular, may experience surges of capital during periods of low global interest rates, followed by abrupt reversals when conditions tighten. As we consider the long-term consequences of prolonged accommodative monetary policy, it becomes clear that financial bubbles are not merely the result of irrational exuberance or speculative mania. They are often the product of structural forces embedded within the financial system, with low interest rates playing a central role. Understanding these dynamics is essential for interpreting economic developments and making informed financial decisions. It encourages a more nuanced perspective, one that recognizes the trade-offs inherent in monetary policy and the importance of balancing short-term stabilization with long-term resilience. Today, as the global economy navigates an environment of evolving monetary conditions, the legacy of years of low interest rates continues to shape financial markets and economic behavior. Asset valuations, debt levels, and investor expectations all bear the imprint of this period. The key question is not whether low interest rates will be used again. They almost certainly will be in response to future crises. Rather, the challenge lies in understanding how to manage their unintended consequences and prevent the buildup of systemic risks. History suggests that financial bubbles rarely burst without warning. Signals often emerge in the form of rising leverage, stretched valuations, and increasing reliance on continued monetary support. Yet these signals can be difficult to interpret in real time, particularly when the prevailing narrative emphasizes stability and growth. This brings us back to the central paradox of low interest rates. The very policies that provide immediate relief and support economic recovery can, over time, sow the seeds of future instability. The transition from stability to fragility is gradual and often imperceptible, making it challenging to address before it culminates in crisis. So the next time you hear that interest rates are being lowered to stimulate the economy, it may be worth asking a deeper question. Not simply how these policies will support growth today, but what vulnerabilities they might be creating for tomorrow. Because the story of low interest rates is not just about economic recovery. It is about the delicate balance between stability and risk, prosperity and fragility, optimism and caution. And perhaps the most unsettling question of all is this. If cheap money quietly builds financial bubbles, can the global economy ever escape this cycle, or are we destined to repeat it, again and again, each time believing that this time is different?